Hey everyone, it's Gary. Hope you all are doing well. Welcome to this week's live Path to Prosperity webinar. Congratulations to all the new folks who are on board. We actually had a week off last week, but there's still some people that joined from different regions. So in any case, welcome aboard to all the new folks. We should have a lot of people from the New York area, New Jersey area. There's Mike Lucas. Hey, Mike, it's good seeing you at the 3-day event. I know it was a lot of fun. I wish you could have been there Saturday and Sunday, but it was good seeing you nonetheless. And it sounds like you and I've got a lot of similar rental property stories we could probably share. So in any case, let's see, Susan, Shirley. Hey, Susan, how you doing? Shirley, hey, Susan, make sure you set up the next strategy call if you haven't already. I'll look and see. I know I scheduled a bunch yesterday and today, but I want to keep following up with you on what we're working on. So in any case, let's see, we've got some veterans on, by the way. Daryl's on. Hey, Daryl, how you doing, buddy? Hi, Dion. Ed Hazel, I saw you earlier. I did Facebook Live. I saw you on for that, so thanks for doing that. Helene, same thing, saw you on there. Okay, let's do this, guys. What I want to do tonight is I've kind of put this off for a couple of weeks. We just had a lot of other things to cover, but Fafsa wanted us to go over this property with him on the webinar. So I'm going to reduce my camera here so I can't see myself and show you what we got from Fafsa on this 31 unit building. And what I'm going to do is I'm going to go through the property using first the Excel spreadsheet rental property calculator, and then we'll move into the rental property reporter, which is the online real-time version. Okay. So in any case, looks like an interesting opportunity. I'm not sure if he might be on duty tonight. He might not be able to join us. Let's see. Yeah, I don't see him on, but he'll get the recording of this. So we just did one of these probably 3 weeks ago for Dan Levy. And then we went over the school report last week, okay? So let me reduce that panel there. We took one of Dan Levy's properties and went through the same exercise. And it turns out, if you remember, the property at first glance looked okay, but when we run it through the 5-year calculator, the 5-year projection, it actually looked a lot better. So, which is often the case sometimes, and it's why we do both calculators, okay? Because one gives you a snapshot in time, and the other one gives you a projection over 5 years. This is really important that you grasp these tools, because whether you're using for yourself or your clients are using them, you definitely want to know how these things work and how they kind of fit together, right? Before we get into a lot of the details, though, just very quickly, some housekeeping, particularly for all the new folks. If you could, hey, Fafsa's on. Welcome aboard, Fafsa. If you please remember to look for the email the very next day after every webinar from Beverly, so you could get not only the recording of the webinar, but also keep up to date with any updates to the systems and the platforms, whether it's training material, new links, things like that. That's all in there, as well as schedule updates, announcing the next webinars, things like that. So and anything else is popping up. So always keep an eye out for that, and make sure you read everything in there, and then download the recordings. Okay, or simply click on them. You can watch the recording again, and then you can, of course, fast forward, replay, slow down, stop, whatever, and take notes. Any case, by the way, the last 3-day event of the year is going to be November 2nd, 3rd, and 4th in Chicago. We've already actually had people sign up, believe it or not. And I think the first email just went out this past Friday. So in any case, keep an eye out for that. I think they do cap it off around 50 at New York. I think like 77 people registered, and they cap it off at like 50, and I think 43 people were there. So there's always a percentage of people that just don't make it for whatever reason. So if you want to go to Chicago, guys, look for the information from Beverly. Go ahead and grab yourself a spot. It's going to be $118 a night per room. Of course, if you're a current student, you don't have to pay for it. You get to go. You don't have to pay for the event itself. You have to pay for your room, and obviously they feed you lunch on Friday and Saturday, and then Sunday we're usually done by lunch. So in any case, look for information for that. In fact, let me know if you could type in your chat box. Let me know if you're going to be going to that. If you haven't registered yet, I just want to let Beverly know. And I see a lot more of you are log in here. So let me do my usual weekly message. Hang on, just to make sure everybody's okay on the technology side. So can you see my screen and hear my voice? Okay, so if you can let me know that you can see the picture of the spreadsheet on your screen. My photo is probably popping up there somewhere, and also the audio is working well. And also, if you want to go to Chicago, just type in yes Chicago, or like to go to Chicago, whatever. The thing I like about Chicago is it's quite frankly not a bad drive for a lot of people. I mean, you can get there from a lot of major areas like St. Louis, Kansas City, Minneapolis, St. Paul, Detroit, Indianapolis, Cleveland, Columbus, Cincinnati, of course, let's see, Madison, Wisconsin. You know, it's very accessible to a lot of people. It's also an easy flight, and usually a direct flight. I know my least expensive flights are always to Chicago, because wherever you are, it's like basically a direct connection. But in any case, if you can let me know that, that would be great. Hey Joel, good to see you, buddy. Hope you guys are doing well. Let's see, Daryl says, where did you get the Excel form? So the Excel form, so Fafsa, Daryl's asking, where did you get the Excel form from? So if you wouldn't mind, Fafsa, that's something that's not proprietary and you can share. We can share that as a file through GoToWebinar. If you want to do that, we just obviously need your permission to do it. So let me know that, send me a text or something, or just type it in here, or remind me via email, and I'll remember to do that if it's something that's available for the public. So okay, let's see. Fafsa says we also went into Dan's property, the mastermind, very in depth. Yeah. So Dan's got quite an opportunity there. So like a 78 or 80 units altogether, something like that. And the one we picked apart the other week was one of the properties that was an 8-unit building. And then we at the mastermind, we basically put it up on the screen for everybody and went through the whole portfolio, as well as what some of Dan's available resources were. And the reason we do that, by the way, is it helps me to know what you have available to your resource-wise, cash, credit, character, collateral, whatever that is, because there's often multiple solutions to an opportunity. And the more information we have, the more creative we can be with our offering advice and making suggestions, okay? So for example, the gentleman that Dan's looking at, his properties, some of them have assumable mortgages, and the guy's obviously leveraged, but it might be a possibility for what's called a wraparound mortgage. And that's where you give the owner of the properties a note, they give you a mortgage that wraps around their existing mortgages, okay? No bank involved, versus a blanket mortgage where you, the buyer, put a mortgage across all of your own properties to free up some capital, like dig up some equity that then you can use to put down on the new property. So different strategies, lots of ways you can skin that cat. In any case, so let's see here. Everybody's saying yes. Erica, yes, I can see in here. Hi, Erica. Hey, Erica, I think we've got a strategy call tomorrow. Yes, we do. Look forward to talking to you. Okay, can see in here. Hoping to be able to arrange Chicago trip. Helene, that would be great, Helene. Let's see, Pam. Hey, Pam, how you doing? Hey, let me know, Pam, if you and Tony want to go to Chicago, okay? So in any case, let's do this, guys. Let me go ahead and jump into this property for Fafsa, okay? 31 unit property, all right? Looks like 3 properties altogether. Purchase price, actually the LOI price is $2,178,000. That's letter of intent price, okay? That's what if you wrote a letter of intent, what you would put on the letter of intent. Let's see, gross potential market income is $220,000. That's a projection, guys. That means right here, this is sort of a pro forma item where we're saying, under certain circumstances, the place could bring in $220,000 in rents, and that's going to be on an annual basis. Okay, the actual rents right now is 205,000. So the upside is you can add 15,000 to your gross receipts, and as a result, you can obviously then positively affect the value of the property, because income properties are valued based on the income approach to valuation. That's an appraisal term. So instead of doing a market approach, in other words, what else is sold, they simply look at the income. They usually do multiple appraisals on a big property, but one of them is always going to be the income approach to valuation. So in any case, a couple things here. Purchase price, 2.2 million. Price per unit's just about 71,000. Rentable square feet is not quite 2,000 square feet. And price per square foot, I don't know if that's altogether accurate, but if it is, it says $1,150 per square foot. Could be possible. So in any case, let's go to get to some actual data, then we'll plug in this spreadsheet, okay? Gross rents coming in is, we believe, 214,000. That's what it could be. That's what it says hours here. All right, per unit, that's about 6,900 per unit gross receipts coming in. That's our projection. That's why it says hours here. If you look over here, it says the sellers, what's actually happening right now based on what they provided us, they're bringing in 205,000 or 6613 per unit on an annual basis, okay? Over here, mortgage information, assuming a purchase price of 1,900,000, 25% down, which would be 475,000, and a mortgage of 1,425,000, okay? Interest rate of 5.5%, amortization over 30 years, all right? So your annual debt service is going to be just under 100,000 a year in this scenario, 97,000 a year in your mortgage payment, okay? The interest only portion of that in year one is almost 80,000. In fact, it's 78,375. Okay, now back up to here, we're anticipating a 2% vacancy rate on this property, all right? And you know, if you look at this, it's $130 per unit over the period of a year. Now, that is a number that's spread across all the 31 units. The reality is you may only have one unit that's vacant for a while at any given time, okay? But we're doing this on a percentage basis. That's why we do that. All right, so total receipts, total rent income, 209,000 based on our figures, 205 for the owner, all right? In any case, if you look down here, trying to find, there we go, move this up here. We've got to look at our expenses, okay? So taxes, 17,776 for the year, 573 per unit. It's actually not that bad. It's under 10% of gross receipts. You can see it's 8.3% of gross rents coming in. The seller's saying they're paying 10,000 a year in property taxes, or 323 per unit, which is just under 5% of gross receipts. I'm going to go with 8.3%, okay? Because I'm guessing this property is either in northern New Jersey or New York. And a lot of times you're paying up to 10% property taxes on a property. It's just amazing, guys, but that's what they're doing, okay? Okay, insurance, $6,500 for the year. The current owner is paying $5,760. Repairs and maintenance, we're projecting $5,000 a year. If the current owner is just saying it's $3,000 a year. I'm gonna go with the higher figure, just because I've been doing this enough years to tell me 3,000. That's a low number for 30 units. That's just not that much. I mean, that's 30 units and 3,000. That's 300. That's $100 per unit per year. That's not much. Okay. That's too low. In any case, general admin, you've got accounting, bookkeeping, advertising, all kinds of stuff, right? There's marketing, utility costs. That seems to be a little high, but let's just go with it, 26,000. On a 30-unit building, maybe that's just all water, and that's it. And that's okay if it's what it is. Contract services, you know, that could be snow removal, lawn care, things like that. And again, total expenses, $58,077.6. All right. So it leaves you a net operating income of $151,022. Now, I will tell you, the property was built, that we know that information. I can't remember when this thing was built. In any case, I'm assuming it's somewhat of an older building. Usually your expenses are going to be higher than that. They could chew up easily sometimes half of your gross receipts if you add all up all the expenses, not including debt service. Okay, then you got to subtract debt service, right? So you got a net operating income 151. You've got some capital expenditures, by the way, that you putting more money into the property, like roofing and things like that. Primary debt service is 78,000. Cash flow before taxes is 64 grand. You got to pay taxes on that. Your cash on cash returns 12%. That's not bad for that part of the country. Cap rate 6.5%. Debt coverage ratio 1.83, which means it's to a bank that looks good. What that is the percentage of rental income after expenses like taxes, insurance, non-debt expenses that are available to cover debt service, principal and interest on a mortgage, in other words. Okay. In any case, let's look over here at acquisition costs, closing costs. Closing costs could be 25 grand based on a property selling for $2 million bucks. We're going to figure capital reserves at 38.75. That's not much, but let's go with it. First year insurance, you got to prepay, correct? Property tax, 3 months worth, 44.44. Utility deposit, 500 bucks. Repair, operational reserves, 20,000. So total acquisition costs could be $500,000, $536,469 to be exact. So, any case, some other interesting data here. Check this out. You got a walk score, 82, very walkable, 48 transit score, and 96 bike score. So there must be some great biking trails around here. Grocery less than a mile away, numerous restaurants, 16-mile ride downtown via bike, and 8 minutes by car. Just interesting facts about the property. So let's do this. Let's go ahead and plug some of these numbers in the rental property calculator. So we're going to suggest here $1.9 million purchase price and $475 for the down payment. So let's go ahead and plug that in. So 1.9 and 475. Okay. 1,900,000. Oops. Purchase price. Initial investment. Well, let's do this. Let's go get the mortgage information first. So hang on 1 second, guys, while I go back here. Mortgage information. So we have a mortgage of $1,425. So let's go do that. Mortgage of $1,425. In other words, $1,425,000. You can see it adjusted everything here to give us initial deposit down payment of $475. And we're going to assume 12 annual payments. I think Fafsa said 5.5%. So let's do that. Amortization 30 years. Okay, let's just double check this real quick. Back here, amortization 30 years, 5.5%. Yep, that all looks good. So let's go back here. So we're going to make the term match the amortization. All right. So now we can see our monthly mortgage payment, principal and interest, is $8,090.99. That's a big one. Now let's get the rental income. So let's go back here. We're going to assume we're bringing in $214,080 at 2% vacancy. Let's bring it up 214. So let's just scratch these off here. Let's say 0, 0. And we're going to say 1 here at 14,000. I'll go back and double check that real quick. So 214 and $80. 214 and $80. Let me do this. 214, $80, and so annual $214,080 by times 12 is 2,568,960. Okay. Actually, that should be annual. That shouldn't be. Let's do this. Let's make that monthly is going to be. Let's call that 19,000 per month. Let's see what that does for us. 228,000. Let's mark it down to 18,000. 500. See if that gets it down to 2. There should be 18. Let's knock off 10 there. Hang on 1 second, guys. Just bear with me. There, 216.6, that's close enough, okay? So let's do this. We've got our gross receipts. Excuse me. We said we're gonna have a 2% vacancy rate. Let's make that 2%. Okay, and that takes us to $4,332 lost in vacancy. So our annual, let me just double check it real quick with Fafsa's figures here. So that should be 214.80, 2%. So effective gross income is 209,798. Let's see if we got close. A little bit high. Let's knock this down a tiny bit. So we need another 2,000. Let's just make this an even 18,000. See what that does for us. Let's make it 17 something. So 17, 500. Too much. Let's make it 17,750. Getting closer. Let's make it 17,850. And there we go. Now we're in business. We're almost spot on with Fafsa's figures. Okay, so let's go back, get some more data. Okay. All right, taxes, 17,776, insurance 6,500, 17,776, 17,776. Insurance we said was going to be 6,500. Okay, let's go see what else we got here. So we're getting close, guys. Hang on to your seats. Repairs and maintenance 5,000. I don't see property management here. Let's just double check. Repairs and maintenance, general admin, utility. So utilities is 26,000. Maintenance repairs is 5,000. Let's plug those in. 26,000 and 5,000. So maintenance and repairs. Let's call that 5,000. And zero those out. This is good. Let's call this 26,000. Let me double check that real quick. 5,000 and 26,000. That's good. Okay, contract services and general admin. So 2,000 and 1,200. Let's do this. Contract services. 2,000, and then legal and accounting, let's make that 1,200. I think that's what those figures were. Let's double check. 1,200 and 2,000. Yep. Okay, and marketing he has is 300. So let's go back here. Advertising. Now let's see if we got this close here. So total operating expenses 60,156. Let's see what Fafsa had. 58,776. 58,776. So we're over by about, let's just get rid of this real quick. These Fafsa figures, 58,156. We need another $620. Let's go back here. So let's just put this back in. 620. Okay, now we should be spot on. All right, so we see here net operating income 151. Annual debt service 97,000. Cash flow before tax was 54 grand. Debt coverage ratio 1.557. Cap rate 8%. So, in any case, this still looks like a decent property, but let's check this out, guys. We don't have property management in here, okay? So we should probably add that. Let me just double check Fafsa's figures and make sure it's not in here somewhere where I just didn't see it. Okay. And I don't see it. Debt service, cash flow before taxes, all those figures are in there. And I don't see, I see maintenance and repairs, we got that. Insurance, we got that. General admin, we got that. Marketing, utility, contract services. I don't see property management. We see closing costs, mortgage information. Okay, so let's do this. One of the things I always suggest, guys, even if you're managing properties yourself, is always account for property management, right? The reason is even though you're maybe managing yourself, that you should be paid for that, okay? You should be paid for those services. That's completely separate from profit. You earning an income because you're managing your own properties is separate than profit. Profit is what you get as being an owner. The job of an owner is to cash checks. That's the job of an owner. You open up your mailbox, you get your income, you put it in the bank. Anybody who's managing their own properties should pay themselves. And the other reason is this. Let's say you are managing yourself and down the road you keep accumulating properties and you decide wisely to turn it over to property management. You better darn sure have that accounted for in your pro forma when you first bought the property. I've seen this happen way too many times. People take a shortcut and eliminate property management because they'll say, well, I'll manage it myself. But managing takes time and energy. And if you get to the point where you're not going to be able to provide that time and energy, then you need to pay somebody else to do it. And the time to account for that is not later on after you've already purchased the property. The time to account for that is when you first buy the property and create that opportunity for yourself so that down the road you could absorb that expense because you've got it accounted for in your pro forma. In the very least, at a minimum, you're paying yourself for managing your own properties. You still get profit, but the profit's what you get as an owner, okay? So having said all that, let me just add in property management, okay? And I actually left in 1380 before, so let's make this, let's make it 8%, which is gonna be about 16,000 and some change. So 16,000, let's call it 17,000, right? Now let's see what happens to our figures, right? So check this out. Cap rate goes down to 7.1%. You're still earning money on the property. You're earning 38,000 in profit. And if you're managing yourself, you just paid yourself 17,000 too, right? Debt coverage ratio is still above the minimum of 1.2 that we like to see. So all in all, I think this property has promise. But what I want to do now is open up the floor for questions before we move on to the rental property reporter, which is the online real-time version and gives us a 5-year projection. So let me just check here and check for questions. Let's see, we got several questions, so just hang on just 1 second, guys. Okay, here we go. So first question, Floyd. Hey, Floyd. You know, it's interesting, Floyd. You know, I'm up here in Ontario, Canada right now because I know we spoke to today. It was 86 degrees here, almost as warm as it is down there. So in any case, all right, Floyd is asking a question. Are the building related expenses, repair, maintenance, etc., after a professional inspection seem light but reserves are pumped up? So Fafsa, let me know if that was after an inspection that was done. I think, honestly, Floyd, some of these figures were received from the current owner. And anytime you do a pro forma, just be aware that they might lowball some of those figures. And what you do is you always ask for due diligence when you actually make an offer, and ask for the actual figures. You know, Schedule E from the tax return. You know, 3 years, by the way, last 3 years of rent roll, last 3 years of profit and loss P&L. And you want to see what they're putting on their books, and you want to see what they're telling Uncle Sam. And the reason is they might be two different stories, and you want to be able to have the opportunity to reconcile that. So I would say those are like myself, Floyd, also. Okay, let me see here. The next question is from Fassel. You can always put the annual rent in the system should be able to calculate the monthly rent. Thanks. That's right. I didn't think about that. Just plug in the annual figure and it'll calculate what it is for the one there. Okay, so let's see. Susan By, 30 years old. I think it's set up top. Yeah, I thought I saw that too, Susan. So that, just a rule of thumb here, guys. The reason Susan brought that up, as I mentioned earlier, the age of the property. Generally speaking, the older a property is, the more you're going to be putting into maintenance and repairs. And the newer a property is, the less you'll have into maintenance and repairs on a percentage basis. When I've had properties where, I mean, literally, you know, overall expenses on the property, add everything up other than debt service, was as low as like 10 or 20%. But I've had other properties where it was as high as 50%. Now, obviously, that cap rate is going to be higher. We have a lower price, which means higher cap rate. And we know that more of our income is going to be going towards the upkeep of this whole building. So 30 years old, that's pretty good because it's post 1978. The reason that's important is 1978 is the year they came out with the lead paint legislation. Anything after 1978 is not allowed to be painted with lead paint when they built the property. Also, if it's 1978, I mean, think about it, guys. My gosh, you've got typically cinder block construction on the foundation, right? You've got modern wiring, so you've got breaker systems for your wiring. You've also got modern plumbing, copper plumbing, for example. Okay, and basically, the house is just going to be easier to maintain. It's going to be less expensive to maintain. Okay, so let's see another figure, Susan by. Where did Fafsa get the figures to fill in the rental property reporter? So Susan, where I was getting the figures that Fafsa had was from this chart here. It's one that Fafsa has, and we're just kind of asking him if it's something he could make available to the public. I don't know, this could be something proprietary, but this is where all the figures came from. And this section here, the gray area, Susan, and for everyone, this is the section that the seller provided. The seller provided these figures. Over here, this blue section over here, these are the buyer's figures, what they project. So you take what the seller's projecting, you take what the buyer's projecting, and somewhere in between, you've got the truth, okay? So those figures came from here, and on here, they initially came from the current owner, okay? And then what we did is we took these figures and plugged them in here on the rental property calculator, right? This is our version. We basically had it cloned from the CCIM rental property or opportunity evaluator program. Okay, let's see. Daryl's asking, what was the opportunity expense ratio, operating expense ratio? So let's go back here and see what that is. So overall, Daryl, 35% of all the gross income coming in or collected after vacancy is being devoted to non-debt expenses. In other words, 35% of every dollar that comes in is being applied towards maintenance, repairs, taxes, insurance, utilities, advertising, list goes on and on. So that's 35%. So that's probably, that'll probably be like in the middle. Remember I said I've seen them as anywhere between 10 to 20% all the way up to 50%. So that's kind of right smack in the middle, actually. Okay, so this is Susan to fill in the first document we saw. Yeah, so that's what I was saying, Susan. That actually came from the owner and from Fafsa himself on that first document. Okay, so Joel's asking, could we elaborate on the debt coverage ratio? Just want to know how the numbers make sense. So if we, let's just go ahead and Google that, Joel. So we'll see, because what this represents essentially in layman's term, this is how I use this. I used to be a banker, and this is what we told people. This is the ratio, basically the percentage of gross operating income left over. So after expenses, which was in net operating income. So what percentage of your NOI is available for debt service? So let's just go have some fun here and Google debt coverage ratio. Debt coverage ratio. All right, formula. We'll just take the shortcut here. So here we go. Net operating income plus interest. Let's do this. Let's go find the actual calculator itself. So Joel, I'm going to pull your panel over so I won't be able to see you guys for a second. Whoops. Because I want to get an actual, here we go. Hopefully this is the simple ratio. All right, here we go. This should give us the ratio, all right? There should be a number down here. Let's see if we can find that. All right, they never give you the actual formula, some of these things. Okay, so let's just go back up the top here. We'll start at the beginning. Whoops, that's not what I wanted to do. Let me go here, get rid of that. Go back down here. Okay, all right, components of debt coverage ratio. Here we go. Formula for debt coverage ratio requires that net operating income and total debt service of the entity. So we got to have your NOI and your debt service. NOI, remember guys, is your gross rents coming in minus your non-debt expenses, taxes, insurance, maintenance, repairs, the whole 9 yards, right? The net operating income is a company's revenue minus their operating expenses, not including taxes and interest payments, okay? It's often considered the equivalent of earnings before interest and taxes. All right, some calculations include non-operating income. This could be something like, I don't know, laundry, utility reimbursement, things like that. As a lender or investor comparing different companies' creditworthiness, or a manager comparing different years or quarters, it is important to apply the consistent criteria when calculating debt coverage ratio, right? So let's see if they actually do that for us. Debt coverage ratio refers to the current debt obligations, meaning interest, principal, sinking fund, and lease payments that are due on an incoming year. On a balance sheet, this will include short-term debt and current portion of long-term debt. And I'm not really liking this explanation because this is too general. We need the specific real estate one. We can look here and see if they give us, interest plus principal minus the tax rate. I don't like that. The ones I've seen are basically real estate related. So let's go back here. And no, we don't want the email. Let's see, where's the one I saw for real estate? Debt coverage ratio. I think I'll get debt coverage ratio. Debt coverage ratio, we did look at that one, debt ratio. There should be one in here. Let's just type in for real estate. Okay, sorry guys, it's taking so long here. Let's go down and see what we got. Okay, here we go. All right, debt coverage ratio defined by net operating income divided by total debt service. For example, suppose net operating income is 120,000 per year. So Joel, this would be like, say you had 200,000 coming in, 80,000 in taxes, insurance, maintenance, and repairs. The remainder is 120,000. You know, total debt service is 100,000 per year. You take the debt service divided by your net operating income, and you come up with a ratio of 1.2 in that example. So the ratio, what I'm getting at is the ratio, you take what's being required to pay the debt on a loan, let's say $100,000, divide that by your net operating income, and that gives you your debt coverage ratio. So let's just see if what I want to do is find one live, guys, that we can actually use to plug in some real numbers. And unfortunately, we're having a hard time finding a live calculator. So in any case, here's again, debt coverage ratio is net NOI, net operating income, divided by total debt service, right? So if your NOI is 120,000, debt service is 100,000, you take the 120,000 divided by 100,000 equals 1.2, right? And that's your debt coverage ratio. Interesting, Joel, they use 1.2 here because guess what the minimum is that most banks would allow was 1.2. In some economies, it goes up to, I've seen it as high as 1.75. But for the sake of the lesson here, 1.2 has always been sort of a benchmark. So in any case, sorry I took long. I wanted to find the actual formula instead of giving it to you in words. So we got it here. And unfortunately, I don't see one live that we can plug numbers in. We don't want to go through all these tables and charts. But let's go back to the class. Okay, we don't want to do that either. So we got to go back to here. All right, now let me go back. Sorry, I need to double check here. I want to make sure I didn't leave anybody hanging here. That was Joel's question. Thanks for the question, Joel. Fafsa says, Susan, the data came from the current owner. Susan is asking, okay, the acquisition cost was almost $500,000. Why doesn't that get calculated into the cash on cash calculation? It seems with a $425,000 down payment and acquisition cost layout, 38,000 cash before taxes doesn't seem that great. What am I missing? Well, I mean, the numbers are, so these are the numbers that we have an example, Susan. That doesn't mean that you actually would buy the property. But by the way, the cash on cash return really is simply the ratio of what's coming in versus what's going out. So if you spend $100,000 on acquiring a property and it's bringing in, $33,000 in your pocket after all expenses, even in all debt service, and you're left with 33,000. We divide 33 into 100,000. You divide your cash in your pocket divided by what you put into the property, and you get your cash on cash return. In that example would be 33%. The thing is about cash on cash return, guys, is that's something we as investors we can influence based on how we acquire the property. We can put more money down, we can lower the interest rate, we can extend the term, we can use other creative techniques. But the thing is the cash on cash return is what we investors look at because we can influence that. On the other hand, cap rate is not something you can influence. Cap rate is what the market is telling you. The market, in other words, the average cap rate for a 15-unit building bringing in $750,000 a year in gross receipts might be let's say 10%. The market dictates the cap rate. All right, the investor can determine what their cash on cash return is based on how much they put down and adjusting terms on the loan and so forth. Okay, so that's why we look at both. In fact, we're going to look at the cash on cash return here in a second. Let's see, Mike Lucas. Hey, Mike. Management fees seemed high. Shouldn't be around 8 to 10%. I think I made mine about 8%, Michael, unless I did it wrong. Also, how could be reduced to 35% based on your experience? So Fafsa, Michael's asking, how can we reduce this 35% expense ratio? Well, let's just take a look and see. So let's go back to the panel here and see what we got. So, for example, taxes. One of the things you can do, guys, is you can appeal your property taxes. I mean, you can actually do it every year if you want. So if you appeal this year and you don't win, you can go back and appeal next year. Some parts of the country say you got to wait every 3 years. But as an owner, one of the rights you have as a property owner is that you can appeal the property taxes on your property. And from time to time you should. I mean, there were years I would do that every single year. Okay. Huge savings in tax dollars. You need to have an appraisal with you to do a proper appeal, or have an appraiser come in for you and speak on your behalf with charts and figures and stuff. So in any case, property insurance. Something else we can do, Michael, is this. Let's say that's what we call the B form in insurance. You've got A, B, and C forms. All right. And what we can do is, let's say this is the B form. We can lower it down to the A form, which is the basic form of insurance, which only covers fire and catastrophic stuff. Doesn't cover flood, doesn't cover vandalism, doesn't cover lost rents. A or basic form is just bare minimum coverage. Well, if you've got enough properties, let's say Fafsa had over 100 properties, individual separate properties. I would definitely encourage him to just get the A form, a basic form of insurance, because I know for a fact over time, his savings on the premiums would far outweigh any loss he might have on a damaged property, flood, fire, whatever. Okay, it's another thing you can do. Management, I mean, I've seen it as low as 5%, as high as 12% in non vacation areas, non-resort areas. Depends on the size of the property, how many units are being managed. It also depends on if there's any subsidies, if any of the tenants are subsidized. You generally have a higher management rate on that, because management companies go through a lot of extra work when they're dealing with subsidized tenants. It's more work, which means they need to get paid more. So you can affect that by basically having, let's say you have a 100 unit luxury complex. So you generally have better properties. You're collecting more rents. So on a percentage basis, I mean, let's face it. Let's say you have a luxury apartment, grade A, bringing in $100,000 a year on 10 units. Okay, and then you have a C property bringing in $100,000 a year on 100 units. Okay, which one would you want to manage more? Well, probably the luxury property, because on a percentage basis, you're going to get more bang for your buck, more income, more fee income per unit, and you'll have a lot less work to do because there's only 10 units versus 100 units on the lower grade property. So in any case, what I'm getting at is you can affect that based on the type of property that you're buying. Maintenance and repairs, I'd leave some cushion there, quite frankly. You can also have, you can put in what we call governors or regulators on all the spigots and faucets and valves to reduce water flow. You can have a high pressure valve, right, or like a shower head, but you can have reduced flow, high output. So you reduce your water bills, okay? You can do that kind of stuff. But those are just some examples. Let's see, taxes, insurance, yeah, that's just about 8%. So in any case, let's do this, guys. We're getting short on time here. I want to run this through the rental property reporter. So let's go there. And I think, where did I have that? I had it up earlier. No, I can't find it. Let's see if I can find it. Okay, let's go here. I don't think, that's not it. That's not it. Ah, bingo, here we go. So here it is right here. So let's start plugging in some figures here, guys. And then we're gonna, this is the one I really like the best. So current value, we said what, 190. Let's just double check that real quick. Or 1.9, I think it was. Yeah, 1.9, loan of 1425. So let's go back here. 1.9, 1425. Then there's another zero there. Cash investment, we said that was a percentage. I'm assuming that's 25%. Oops, let's go back. 25%, 475. There we go. Mortgage rate was said was 5.5. Okay, 5.5. Let's bring this down so we can see the assumptions. Okay. Okay, assumptions. Loan term 360 months. Purchase cost, I think we had that at about 1%. Let's see, closing acquisition was 1.35%. So let's go back here. 1.35%. You know what? It's Fafsa. It's not going to let me do that. 1.35. Nope. We'll just keep leaving it at 1%. Okay, monthly rent. We said that was going to be 214,000. Well, we need to do this on an annual basis. What do we say that was on the Excel spreadsheet? 17,850. So let's go back here. 17,850 per month. 17,850. Okay. Cap rate. Obviously, that's not going to be there for long. So cap rate. Right now, guys, we're making a 50% return on our money. How about them apples? Well, it's about to change. Okay, assumptions here, property improvements. So property management, we said we're gonna make that 8%. Okay. 8%, why isn't it letting me, I don't know why this is doing this. So usually you can change these things. Initial expenditures to get the home ready for rental. Let's just go back and see what Fafsa's figures were on that. And we'll come back to this. The closing cost, cash reserves, let's just call it 3875. Okay, that's not what he intended there, but we're going to use that figure, 3875. Okay, for some reason, guys, this thing is forcing us to use 10% cap rate. Maintenance is forcing us to use 1%. 1%, so we have to leave these the same. Okay, move in, move out costs. It's $2,000 per move. Okay. Insurance cost, 0.5% of gross receipts. That's all pretty much within a valid range. Okay, now selling price. This is if you were to sell it 5 years later. We're assume selling cost is 6%, appreciation rate of 4%. I'll go for that. Value of land. Let's assume that is going to be 3%. Okay. Of the total purchase price, which is $57,000. So tax basis is $1,843,000. property tax rate, percentage of property value. Let's call that 3%. Okay, so that's our assumption there. Further assumptions: your annual tax rate 25%, capital gains 15%, expected inflation 2%, investment hurdle rate 8%. So remember, investment hurdle rate, what that is that's like, let's say your other investments have been giving you an 8% return. You got money in stocks, bonds, and mutual funds. You make an 8%. This is the hurdle. This is what you have to overcome if this is going to be a good investment. It should be returning more than 8%. Otherwise, you would just do the 8%, right? Okay. So let's go look at some results of our math. So initial investment 475. Projected cash flow, year 1, year 2, year 3, year 4, year 5. Year 5 is assuming the sale. That's why it jumps up from 500,000 to 1.259 million. Okay. Your total cash flow from rents and your eventual sales, 2,732,000. If you kept it for 5 years, that's 5-year projected internal rate of return. This is the assumption here with this calculator, is you're keeping it for 5 years. Okay, so let's see some details on this opportunity here. All right, so first things first, we want to look at cash flows and return on investment. So initial investment, 475,000. Cash flow over the years increases over time, and eventually have a sale, right? Sale price, assuming you sold it at 5 years, will be $2,311,641. Okay, your selling cost is going to be $138,698, based on the figures we provided. So your taxable gain is going to be $599,000. In other words, what you put into the property, its appreciation, and eventually got to take your depreciation of that, which we'll do here in a minute. Okay, but so far, you still got to pay off your note at $1,320,000, right? Remember, you financed more than that. You financed, let's go back here, $1,425,000, is that right? So if we reduce that, we've paid off about $105,000 based on this. In any case, your total annual cash flow, you can see you're negative initially, and over time, you got a cash flow, a very positive cash flow. I wonder if I got those figures right. Let me just go back up here real quick. Tax basis, land, sale price, property improvements, monthly rent. Aha, well, here's the problem. Monthly rent, we said, was going to be $17,850. Now this is going to change things. Look at that. Now cap rate's down to 11.27. Right, still pretty good, but all these other figures should look like make a lot more sense. Now they make sense. Okay, so year 1, you're going to be negative. Year 2, you turn a profit. Year 3, year 4, year 5. We've gotten through that so far. Let's go back down. There are calculations here. There's your cash flow again. So if you look at your ROI on a percentage basis, return on investment, you can see it goes up over time. And at the end of the 5-year holding period, including your sale, you basically had a 12.9% or 13% return. Present value cash flow is discounted by hurdle rate. In other words, if you took your returns from this property and reduced it by your hurdle rate of 8%, this is what you would have over and above that hurdle rate. Over and above 8% is $39,479. All right. Your walk away price would be, in other words, you wouldn't sell this thing in 5 years unless you, at a minimum, could get $1,900,000, which means you probably got a pretty good deal to begin with, 1.9. Okay. In any case, sales price. Assuming we did sell it with an annual appreciation of 4%, remember that? In 5 years, it'd be $2,300,000. Selling cost $138,000. So your cash proceeds at the sale before you paid off the mortgage and your taxes is $2,172,000. You depreciated the property over time, so your depreciated basis, if you took what you paid for at 1.9 and subtracted your depreciation, that takes your cost basis down to $1,573,000. Remember, when you sell a property and you depreciated it, you've got to do what's called recapturing the depreciation upon the sale. They're going to literally take your actual cost basis and reduce it by all the depreciation you took. So you're going to pay taxes on a broader spread, okay? In any case, taxable gain of just about $600,000. Depreciation recapture, tax 83 grand. Your actual tax capital gains tax is 61,000. Okay, in other words, 25%. You've reduced it by 325,000, and roughly you're going to pay taxes of 61,000 on that recaptured gain. All right. Okay, you paid off the note, 1,320,000, and your cash proceeds from the sale 706,000. You know what? That's not looking too shabby, actually. So let's look at some other figures, and then we can wrap this up here. So let me go. Every time I do that, calculator does that. Sorry, guys. Okay, financial projections. So you've got your rental income coming in, increases every year by 4%, I think we said. Your interest on your loan decreases over time, right? The taxes you pay go up a wee bit because the property is going up in value. That's your property taxes. Your insurance is going to inch up a wee bit, right? As a percentage of your value of the property. Tenant turnover costs, every time a tenant leaves, you got to redo the painting and the cleaning and all that. That's that figure there. Okay, maintenance costs, we're going to stay fixed, but I think it's probably going to go up over time. Purchasing costs or buying costs, we said was going to be about 1%. That's your 19,000 there. That's a one-time figure, right? All right, professional management, we figured around 8%. You can see what that adds up to over time. Total rental expense, you can see you're literally, I mean, it takes a lot to run a building, right, guys? And that's what this is telling you. Over time, you would spend almost $1 million, managing the thing. So in any case, net income, there you go. Over time, we add everything up. Your total net cash, your net income is 109,000. You got to add back in depreciation, the taxable income, your tax, the cost, right? Your principal reduction, you paid your principal down by a total of 104,000. You reduced the principal balance by 104,000 over the 5 years. Okay. In your net cash flow, you can see you do turn a profit in year 2, 3, 4, and 5. And in the upon a sale, you actually add more to your cash flow. All right. So we're almost done. So bear with me, guys. I know we're going to be running a little bit late here. I want to get to the final analysis of what I want to do. Okay. So at the end of the day, if you look at this return on investment tables, your initial investment is fixed up top there. Your yearly appreciation, it goes up in value over time. Annual appreciation net of taxes, once you take taxes out, this is what's left on appreciation. Your net cash flow over time, not too shabby, it goes up over time. Your net worth increase, you've increased your net worth by a total of $100,000. And your ROI, your basically your return on investment, if you look at this, in 5 years ends up being 21%. That's why I like this calculator, because it's most times we look at these properties at a fixed point in time, assuming that's the way it is forever. It's not. The property should continue to improve over time on a financial basis. Okay. By the way, here's what your loan looks like over time. So you got your loan initially $1,425,000. You reduce it over time by 104,000. So when you pay it off, it's 1,320,000. Interest on that, you can see that goes down over time. Principal reduction increases over time, and your mortgage payments, these are the mortgage payments you made over the 5-year period. Okay, so bottom line is this: 21%, guys. Would you do this deal for 21%? So let me bring your panel back over, and I can look for questions. Okay, so let's see. So that was Mike's question on management fee. This is Fafsa. So Fafsa was okay. How could we add value to the property for more profit? Also, how could we reduce the 35% based on experience? So that same thing, Michael. You guys are asking the same question. It's a good question. So some of the things I've done in the past to improve performance on a property. The most obvious is obviously whenever I'm in there making maintenance and repairs, particularly the turnover time, I'm going to see what I can do to raise that unit to the next higher level of marketability. That means increase the market value of the property by putting in new countertops, new lights and things like that. Now, having said that, I would say they always need to be, those improvements need to be within the range of what's commensurate for the area. You don't want to over improve a property. The point I'm trying to make is within that construct, we improve the property so we can raise the rents. And that's just basically on a per unit basis over time. Some other things you can do, guys, are this. If you don't have laundry in the facility, add laundry. Anytime you got more than 5 units, add laundry. If you don't have storage, add storage. If you do have storage and you're not charging for it, you should definitely charge separately for storage. Believe me, if you're not doing that, you're leaving profit on the table. Storage rental, always separate from the residential unit rental, okay? Another opportunity could be, do you have garages? Believe it or not, we charge separately for the garage too. And nobody ever balks on it. People who are willing to pay rent on a garage is because they generally have a nice car, right? Or a collector's car or something like that. You can also see if there's opportunities to add units to your building, okay? Adding unit means maybe you've got a fully built attic that meets the height requirements, has access, two means of access, for example, windows and things like that. And all you need to do is bring up the water and electric and gas and heat ducts and things like that. I've done that before. I've also added bedrooms to existing units. So let's say you walk into a big apartment complex, there's a common wide open area between the units on this side and units on this side. If it's 10 or more feet wide and it goes all the way back and there's a big window there, I'm going to bust a hole in one of the walls for one of the units, put a door in, put a wall across the front of the hallway, and I just created a brand new bedroom for the cost of one door and one wall. I've done that probably dozens of times over the years. Look for existing space that's dead space, that's common space, and if you can commandeer that and add it to one of your units, you just turn a 2-bedroom into a 3-bedroom, and now instead of getting $1,000 a month, maybe you're getting $1,350 a month. So this is some ideas you can do. You can add amenities like really nice landscaping, building decks, and having community rooms, things like that. I never found that to add much value. What I found to add value was laundry, storage, additional bedrooms, and additional units. That's where the money's at, okay? And separating out storage and garages at every turn of the way, all right? If you don't even have a garage with an apartment building, but you have off-street parking associated with the building, in places like New York, New Jersey, San Francisco, Boston, Toronto, Montreal, any of those big cities, you can charge separately for those parking spaces. Seriously, if you're not doing that, you're leaving money on the table. So charge for that stuff. So Fafsa, I hope that answers your question, but those are some of the most common things I did. Okay, so Susan asking, so the higher the ratio, the more room to pay the debt. Yes, that's exactly right, Susan. The higher the debt coverage ratio, the more comfortable the bank feels. Remember, banks, it's all about risk. The lower the debt coverage ratio, the more risk for the bank. The higher the debt coverage ratio, the lower the risk for the bank, okay? Good question. Okay, so Joel's asking, I appreciate that, Gary. Thank you. You're very welcome. You're welcome, Joe. Okay, let's see. This is who's this? Daryl. Hey, Daryl. Okay, Daryl. The debt coverage ratio means the one is telling the bank you are able to pay the debt and have cushion of the second number. Example 1.25, you have a 25% cushion above the mortgage payment. That's essentially true. That's a good analogy, Daryl. Thank you for sharing that. Let's see. Why isn't the initial acquisition cost or closing cost not in the details? There actually was, Susan. Let me go back over here real quick. Let me go way up to the top. I think it's in here anyways. Okay, so purchase price, the percentage of the cash deposit, down payment, mortgage rate. Okay, expected returns, that's your rents, rental costs, property improvements. Okay, here it is, this initial expenditures to get a home ready for rental. So Susan, that's kind of where that is right there. And we just plugged in $88,750. I think Fafsa had $3,750, and I mistyped the 8 for a 3. So that's where you plug that in, right there. Okay, let's see, what else do we have here? Susan, is the 706,000 cash after deducting the initial down payment. 706,000 cash. Let me see where that is. It's probably in one of these charts here. 706. I don't remember seeing a 706. Now my eyes are starting to go a little batty here. Oh, here we go. Okay, cash from sale. So Sydney, here we go. The cash from the sale. If you sold it for $2,311,000, you have selling costs, right? Cost of selling, taxes, commissions, things like that. So your cash proceeds after all that is $2,172,000. Your depreciated basis is 1.573. In other words, we paid 1.9. We depreciated it down to 1.573. All right. So now our spread, our cost basis that we're going to pay taxes on is this now, this spread, not the old spread. All right. So taxable gain, if you took 2,172,000, subtracted 1,573,000, you're going to pay taxes on $600,000, right? In any case, depreciation, you got to recapture, you got to pay taxes on what you recaptured. Depreciation isn't free. You're just basically deferring. You get you get temporary use of the money, right? You're borrowing the money temporarily from Uncle Sam. It's your own money, but you're not going to pay taxes on it for the moment. Capital gains tax, 61,000. So if you took, I think it's your 25. Did we say 25% tax rate? I think that's what it was. You got to pay taxes. So so Susan, your question is what is this number? It's actually after you paid off the taxes and the mortgage. That's what you actually put in your pocket, literally cash from the sale in your pocket. Okay. Let's go back here. Let's see, Susan, what is the life of building for depreciation? Yeah, there used to be, Susan, there was a commercial rate that was like 39.5 years and a residential rate that was 27.5 years. They have since collapsed that. In most cases, it's all 27.5. So astute observation there. Ladies asking, do you recommend that we sell it in 5 years? Are there calculators that calculate it for 5+ years? Yes, lady, every investor has their own motivations or own objectives. And what I tell people is it's a case-by-case basis. I've held properties for 7 years. I've held properties for 27 years. I've held properties for, my average is 12 years. My average hold time, guys, has been 12 years. But it's not that I determine that up front. I just determine when I was going to sell properties individually based on the surrounding market, what I can get out of it, and what the other opportunities are for me to use that money for. So in this example, it tells us you wouldn't sell it unless you could sell it for, I think it said 1,943,000. That's break even. We obviously want to turn a profit. So in order to do that, we want to sell it for 2.3 in this example. So I wouldn't necessarily sell it. If I'm happy with the property and it's producing income, I'm going to keep it, right? Okay, let's see. Joel Martinez. Joe is asking, okay, so over a span of 5 years, you only earn a total of $23,956 net cash flow, basically putting down $400,000 to get back. Well, that's on your cash flow. I know what you're asking, Joe, but you have to take everything into account. The cash flow while you own it, plus the proceeds from the sale. Let's just go back here and go back up again. All right. So we need to see cash flow. Where was this? Cash flow. Yeah, each year. So you put down 475,000. After all expenses, everything, you're going to make essentially, that's a 5% return. You're going to make essentially a 5% return is what you're getting at. That's just during the life of ownership. But when you sell it, obviously you make a whole lot more. Right? You're going to cash in and put in your pocket 706,000. So think about this. You put 700,000 in your pocket on the sale. You made essentially about 20,000 a year, which is another $100,000. For 475, I'd probably do that, right? That's why I love this calculator. So it points all these things out. It makes you see things objectively. Okay, so this is Susan. So do you pay taxes on the 706 or 706 minus the 470? Yeah, no. So Susan, let me go back here real quick. You've already paid taxes, so the 706 is what you put in your pocket. Okay, cash from the sale, less taxes and debt service. In other words, you've already paid your taxes. and you paid off the mortgage. That's what you put in your pocket. That's what I'm saying. This is looking like not such a bad deal. Okay, guys, about 10 after 8, that was the last question. I appreciate your participation. Next week, let me just double check this. We will be meeting on the evening of the 15th next week. And if you have suggestions for things to go over, I've already got a few from other people, but I like to basically, whatever suggestions we get, whatever one gets the highest votes, that's what we cover on the next webinar. So whatever you want to cover next week, use the email, let me know, and I'll make sure we're prepared for that. Otherwise, we will see you next week regardless. The 15th at 7 p.m. Eastern. God bless you all. Let me know if you're going to Chicago. We do try to reserve seats for as much as we can for our current students. And you get to go for free, by the way. Everybody else has got to pay, but we would we'd rather see you guys, quite frankly. So if you can go, that'd be great. I'd love to see you there. You guys have an awesome evening, a great rest of the week. Hope you and your families are doing great. If you're Canadian, happy Canadian Thanksgiving. Yesterday, I ate my 32-pound turkey up here in Ontario. So, and I get to have American Thanksgiving in another 7 weeks or so down in Virginia. All right, guys, have an awesome night. God bless you and your families. We will see you next time. Bye-bye.